Hello, friends. Today we're talking about TITN Machinery, ticker symbol TITN. This is a small cap company, and the reason why we're looking at it is because back in my PayPal video, JR Venta asked me to analyze that company, and I was waiting for the earnings to come out and then just to learn more about the company because I wasn't very familiar with the company. I'm not an expert on this company, and so just whatever I say, remember that it's just for educational purposes. I am not a professional investor, and I'm not your financial advisor. So make sure that you understand that this is not a advice to buy, hold, or sell this company. We're just going through and learning about this company. In the last month, it has gone up 5%. It went down on earnings almost to $21. In the past year, it has had a big drop of 35%. And in the last 5 years, it's been growing so far about 45% if you hold it 5 years ago. This is a very interesting company because stock analysis, most analysts are thinking that it could get somewhere between $38 all the way to $42. That will be somewhere between 50, somewhere around, I think it's 50 to 63% target. They do not pay a dividend. They have a really low PE of 5. And one of the things that is very interesting about this company is that they are growing by acquiring other companies. And we'll be talking about that in a little bit. Talking about undervaluation, Yahoo Finance believe that it's undervalued 25%. So the question is, are they right? So let's jump into it and start looking at the company. First, let's start with who are they? Because I'm pretty sure that most of you guys don't know who they are, and probably this video is gonna get only like 12 views, but that's okay because I'm committed to this community, and I promised that I was going to do it, so I am going to do it. TITN Machinery is a dealership for construction and agriculture equipment. So just like you go to a dealership for a car, you can buy cars there, you can buy trucks there. Also, you can get service, and you can also buy parts for your cars. In the same, they do the same thing, but for construction and for farm equipment. So they sell new equipment, but they also sell used equipment. They also rent the equipment. You can buy the parts, like I just mentioned, and also they provide service, and they do make a lot of money on all of these areas, of course. So that's where they get their income. They were founded in 1980 by David Meyer, and they are mostly located, I believe, is in North Dakota. They have 93 dealerships in North America, including North Dakota, South Dakota, Iowa, Idaho, Minnesota, Nebraska, Wyoming, Wisconsin, and Colorado. And also 35 dealerships in Austria, Romania, Bulgaria, Germany, and Ukraine, which their dealership in Ukraine, of course, because of what has been happening over there, has created some problems. And so that is part of, because of the war of Ukraine, you can see here that it has affected a lot of the different income that they were having. So let's talk a little bit about another thing that they just did, and they just announced in the I think it was in August, is that they just acquire a new company called Johnson. O'Connor and Sons, which is is Australia based. So now they're going to be in 3 continents. O'Connor's is located in southern, southeast, southeast of Australia, and one of the things that they have been there's 2 things that they are going through. One of them is a leadership change. They're changing from their company founder, David Meyer, to their COO, which will become the CEO on February 1st. His name is Brian Knutz. So like I was saying, they just completed the acquisition of the Australian base, and they're working through all of the succession leadership plans. I do like the fact that they're not bringing someone from outside, but they're bringing people from inside, because that helps with the culture and helps with continuity. There's a person that already knows a lot about what is going on. When I was talking about the way that they have increased, they have been growing by acquisition. In April 2022, they acquired Mark's Machinery. In August 2022, they acquired Harlan Agricultural. Then on February 2023, Pioneer Farms. And then on June of 2023, Midwest Truck. So, and O'Connor's just happened. So right there, you can see that that they have acquired 5 companies in less than 2 years. So, and that is going to be reflected whenever we jump into looking at some of their financials and stuff. One of the things that actually affected a lot of their finances is the inventory issues. There's 2 issues that they had. Number one, by acquiring a lot of these companies, they have acquired a lot of new equipment and some of the used equipment and parts, and that has created a little bit of a backlog with that. And also, my understanding when they were talking about in the 3rd quarter earnings report is that they had ordered a lot of new equipment and it was already paid for, I think. But because of delays of parts and all the issues that they had last year, not they, but all companies had with the supply chain, the new equipment was not delivered until this quarter. That's my understanding. What kind of I remember from the call, and so what they were explaining is that because the equipment was received during the height of the farming season, it was very hard for them to, and they had a lot of service calls and service maintenance and stuff. It was very hard for them to manage the service side and having to go through, I guess, putting together or something. I don't remember very well, but they had an issue getting the new equipment that they received ready to be sold. So that created a little bit of problems when it came to their cash flow statement. If you see their net income, it has been going up, but one of the issues that they have had is that it's the inventory, that the change on inventory really hit them in the cash flow statement. So with that said, before we continue and we'll jump into the financials and evaluation, I just wanted to remind you to subscribe. I believe 96% of you guys have not subscribed, so I encourage you to subscribe and support the channel. Leave a message if there's a stock that you would like me to analyze. Please write it down there, any ideas, hit a like, comment. Also, you can go to my Buy Me a Coffee page where you can now get the valuation form, or you can also leave me a message if you want. Okay, so let's jump to the analysis. So revenue, one of the things about this company is that it's very cyclical. And one of the things that I kind of like with the acquisition of Australia is that it's going to normalize, I think, it's going to normalize a little bit their income. Why? Because if you remember, if you probably know, when we are in winter, they are in spring. No, winter's it's in summer. So they're opposite. So they're going to be able to, when we are in winter, which we're not harvesting or planting, Australia is going to be planting Australia's and planting, and that's going to help with that. Also, they mentioned that it will help with the call centers, because you will have now 3 call centers, or 3 ways of 3 different time zones in which you can help their customers and receive calls pretty much 24/7. This is a company that is cyclical, even with those changes. So as you can see, it goes. The revenues have been going up and down. It's not constant. In the past 5 years, it has gone up 14%. Earnings, they were in a loss, and since 2018, they have been now in the positive. And in the last 5 years, they have grown. Their earnings have grown 53%. And then I wouldn't consider this a good number to look at. So we're just going to skip that. Profit margins, this is a problem that they have been having lately, is the profit margin is about 1.37%. If we look at the data over here, we see that the profit margin has been going up, even though that's the average. The last profit margin was 4.28%. When it comes to free cash flow, it's all over the place. This has to do with acquisitions. This has to do with a lot of different things. This is part of the reason why I'm not going to be really looking too much at the free cash flow valuations that we normally do, because, and this will be a reason if I wanted to put a negative of why not to invest in this company, will be precisely this. Because it's very hard to have an idea of how to use these numbers to find a valuation. With the earnings, you kind of can see a trend from 2015 and up. Revenue, you could just take an average and make it flat. But free cash flow, it goes from $10 all the way to -5. So that's a lot of difference, and most of this has to do with the inventory issues. So book value has been growing, and partly because of the acquisition, but partly because of the equipment and assets that they have acquired. This is a very important thing if you're looking at buying this small company. I will encourage you to be looking at book value. So I will be looking at book value, which will be, okay, what will be if I had to sell off this company, if I own this company and I had to sell it off, sell all the assets, pay all the debts, what would it be worth? And it would be about $27.80 of book value. So this is what they call zombie evaluation. So just take that information with a grain of salt. In the last 5 years, it has been growing 12.5%. Return of equity in the last 5-year average is 5.4. I always normally look for 10%. Return of asset is at 2%, which I normally look at 5%. And return on invested capital is 5%, which it kind of makes sense because it's a company that is kind of growing, but at the same time, it has been around since 1980. So I think that right now, it's just my opinion, there are better companies out there to invest and have better numbers, have a little more consistent in all the numbers. They don't have a dividend, which I'm okay because they're growing. Debt levels are okay. They have been stabilizing, even though it says that it has been growing. In the last 10 years, have been going down 6%. In the last 5 years, just because of the 2018 big jump, it says 42. So it has been regulating. So if they were to pay, if they were to take the average free cash flow, and it will take them 4 years for them to pay all their long-term debt. But once again, free cash flow is up and down. So take that with a grain of salt. Outstanding shares have been going up. However, the number is kind of consistent, and they have been growing by just 0.8, 0.6, 0. About 0.6. Sorry. So that is a very small amount. I'm not too worried about that. So one of the things that I notice is that Yahoo Finance, that's where I normally look at the analysts, what they're predicting for the next 5-year growth. They have it at 25%, which is a crazy amount if that is true. I just don't know how they can see that kind of grow with if they continue to acquire different things. I mean, earnings have been growing 5%. This one is negative. So I don't know. When it comes to multiples, I'm not going to use the free cash flow because per share multiples, because it is too low and they don't have a dividend. So I'm not going to use that. But if we see the revenue per share average in the last 5 years is being $78, and the trailing 12 months is 110. So by the multiples, we're talking about $22 to $32. You can see the other different valuations. We will be looking at a fair price somewhere between $23 to $36 if you look at the average or the trailing 12 months. When it comes to payback time, I am not going to use this because you have negative numbers. The discounted earning valuation using 11 PE, which is the average, and using a 15 instead of 25%. It is a little more conservative. We're looking at an average of $26 all the way to $51. The owner's earnings valuation, we're looking at somewhere between $50 to $35. And when we put everything together, we'll be looking at a number between $27 and $43. And this is where you personally need to do research. I just took a couple of days to research this, so I wouldn't be comfortable investing in this company, and I'm probably not gonna invest in this company as of right now. I think there's better places where to do it. But if you disagree with me, that's completely okay. Right now it's trading at $26, even though it keeps going up. It's crazy. It's at $27. So if you were to take the difference, let's say that you take the average, let's say that is $34 minus 27, let's say that you buy it by the time you watch this video, that's 7 divided by 27. We're looking at about a 26% margin of safety, or up possibility of growth. So I don't know what else to tell you. Just remember, this is just my opinion. Do not make any decisions based on my comments. Please leave a comment. Let me know what you think. And I hope to see you in the next video. Thank you.